let's get started. Michael, would you like to go ahead and give a short introduction?
Sure. Michael Gray, I'm a partner at Neal Gerber Eisenberg. We're a law firm based in Chicago, about 130 lawyers. My personal background is I did my undergraduate in math at University of Chicago. I got a master's in physics at U of I, JD from Northwestern. Practiced law for about 5 years. It was largely venture capital, private equity, and partnership work. I then went through a 7-year sojourn being an early stage investor. So I was on the principal side for about 7 years at 3 different firms. So I kind of can sympathize with both the entrepreneurs and Jonathan and early stage investors and everybody involved in this ecosystem. And then through a very circuitous route, I ended up back practicing law again, which for me has been awesome. And today my practice is largely comprised of companies and investors in this world, ranging from complete raw startups to, we get to work on some of the larger equity financings, whether it's a $30 million round or a $70 million round, or I'm actually involved in a $500 million round right now, which is frankly more of a rarity, but you get to take a lot of that information as a lawyer and then see what's happening later on and help people at the earlier stages to avoid mistakes that happen frequently. Nicole?
Thanks, Michael. Yeah, hi everyone. My name's Nicole Staple. I'm a founder and CEO of Brideside. We've been working with Neal Gerber for probably about 2.5, 3 years at this point, and have really enjoyed that relationship. So a bit about me and the company as a quick personal background for founders that are on the line that are always interested in hearing other founder backgrounds. I was actually in finance prior to starting a wedding retail company. I worked in investment banking and then tech venture capital out in the West Coast. Went to business school at Kellogg, graduated from the full-time program in 2012, and met my co-founder while I was a student there. In fact, we met our very first day of school and never knew that we would be, I guess, married, for lack of a better word, 10 years later. But we launched the company right out of Kellogg. And so it was an interesting experience going from really a project to now a company that is much bigger. So Brideside was one of the early retailers in the bridal retail space, the digital bridal retail space. So we started as a group shopping platform for wedding parties, specifically bridesmaids, to buy bridesmaid dresses online. We're a very service-driven model. So we have in-house stylists that can work with a couple from start to finish on their wedding party look. And fast forward several years, we moved from a purely digital platform to very omni-channel. We have retail locations in Chicago, Boston, New York City, Charlotte, North Carolina, a try-at-home program. We also now sell the bridal gown, accessories. So we've become really a one-stop shop in bridal retail.
Awesome. Well, thanks for the intros. So to get started, we'll talk about the general fundraising process. And Michael, obviously you've had a front row seat to many rounds of financing, both as an investor and a lawyer. Do you think founders generally do a good job fundraising?
I think it is a completely mixed bag. I think some are incredible at it. Some I think are frankly so good at it that they're better at fundraising sometimes than actually operating their business after they get the money. And then others who are very worthy of getting the capital sometimes just don't know how to work through the sales part of the process. I think the one thing to always keep in mind in doing any sort of fundraising is that this is about as relationship-based a business as there is out there. This business is 100% about trust. If there's one thing I can tell everybody, and I've got my one personal experience where I had a bad business partner, no matter what lawyer you hire, no matter what legal protections you put in place, if you pick the wrong partner for yourself, whether it's as a co-founder or an investor, you're going to find yourself in a world of hurt. And I think that that's one of the most critical things, is to think about the dynamic and use your EQ as much as your IQ in this business. And I think one of the most important things that I always try to tell my founders to do when they're raising money is it can be a long process, especially if you're early stage. And currently in the world that we're living in of COVID, it's a particularly strange dynamic. But I think that if you have a discipline of sending out a monthly newsletter to people and having goals and objectives, and you have your team participate in that, I think that the CEOs who I see do that tend to be some of the best leaders. And I think if you've got that discipline to do something like that, and, you know, after this, Jonathan, maybe there's a few things, you know, we could share where we could maybe, you know, like I've got a whole list of things for people to think about as business owners, and just like a laundry list of like things just to like check the box. You can't afford to do all of them, but maybe you and I should send out a template. You and I could redact some of the really good founder letters and redact one out, because I just think building that type of a relationship, showing progress, that your goals and objectives oriented in what you're doing is really important.
Yeah, that makes a ton of sense. I think I always talk about people, you know, invest in lines, not dots. And the first time you meet someone, you know, that's really that first dot. And it's really 80% of the ideas that we see, I think, you know, are interesting. It's really about the execution and the momentum. And so those regular updates, I think, paint that picture and show that you're sort of disciplined and you're transparent. And you know, a lot of the times they'll include asks. So that's huge. You know, if an investor's sort of interested in what you're doing and they can make an introduction to you to help you out, to make you more likely to succeed and more likely that you perhaps want to have another conversation with them, that's a huge win.
And, you know, one other thing, just so I don't forget, is that at the end of these emails, and generally it goes out to a fairly broad group when I see them, so you've got to also be smart about confidential information. But some of the really, really smart founders at the end of it or at the front of it say, here are asks from people in my network. Can you help me with X, Y, and Z? I'm looking for a product person. I need to get access to somebody at Amazon. I need to get to this person. Who can help me? And you got to, if you don't ask, you're not going to get.
Makes a ton of sense. So Nicole, you've obviously been around a few years now, and you've raised capital successfully across a few stages. I mean, can you describe your fundraising journey?
Yeah, sure. I think, Michael, everything you touched on is really important, because you know, fundraising, in my experience, and hopefully other founders too, is just never a straight line. If everything goes completely according to plan, great. Awesome, you're set. Maybe you should just leave the webinar now. I'm just kidding. But you know, things don't necessarily go according to plan, whether it's in your fundraising process or your operating plan. And so I think Michael's point specifically around that relationship building and transparency is so important in the journey. I mean, we have investors today, you know, during COVID that have stepped up, that were literally some of the first people I met when we didn't even have a company. And building that trust over a long period of time can really be important when you're in pivotal moments in the company. And so my fundraising journey, you know, to give you a little bit of context, we've raised about 17 million in capital. This has been over angel, seed extension, and an A. And what I would say is, first and foremost, we were always very metrics driven. So we're in bridal retail. 95% of, in the early stages, the folks who I were pitching, it was usually a male audience. And that in those early stages, many investors want to feel like they can relate to your business, or they really understand the pain point. And maybe if your product isn't aligned with the type of investor you're pitching to, you have to think about framing it in a way that creates a common ground and a common language that you can speak to. And for us, that was really around the metrics. So I guess to give an example of that, we were a bridal party shopping experience. And so the great thing about that is that when a bride decides to work with you, her 4 to 8 friends, her bridesmaids, also purchase from you. So there's a really interesting virality network effect in our specific category. And we really leaned on that in the early days. And we lived and died by showing that lifetime value would really sort of multiply over time, which is actually proven out to be true, and has, you know, it's still a metric we really lean on. Another example is that we decided that we were going to create a service experience as our secret sauce, or a stylist model, which we felt was really important if you were going to bring weddings online, to help people get over that hurdle. And so when you sign up at Brideside, you're matched with a stylist. And so people are very worried that headcount can be very expensive. It's hard to manage a sales team. So what we led with always was our conversion from a sign up to a sale, saying if you're just an e-commerce site, our conversion might be 1%. When someone signs up, it's 30%. And we could really show that the service-driven business was important for maybe someone that didn't quite understand how the industry worked. So we've stuck behind that metrics-driven approach from the beginning. I think that's actually allowed us to broaden our reach in terms of our investor base as well.
That's great. Yeah, I was about making it obvious. It's like, you can kind of sort of think the idea is interesting, but to really demonstrate that it's working, demonstrate that the product market fit, demonstrate that the metrics are there, then even at a glance of the pitch deck, you sort of like, oh, okay. And then you're more likely to lean in and dig.
I think that's particularly true in the Midwest, by the way. I've fundraised on both coasts, and I don't know, Michael, if you would agree, but we were actually pretty much forced to show metrics when we were pre-revenue. Midwestern investors, at least when we were fundraising, now we've been around a while, we're very, very conservative, and we're really about building strong business fundamentals, unlike maybe in San Francisco where you're investing much more in a vision. And so I do think if you're in the Midwest, it's a really important thing to think about early, even if you don't have revenue. What are the early leading indicators that you can show that give people confidence?
And I totally agree. I think the more you've got KPIs and can track them and kind of force yourself to, look, you're going to put a fork in the ground over here and you're going to go for that direction, but ultimately you're going to look at the marketplace and see where the traction is getting. But if you're thinking through KPIs, I just think it's so important, not only for you to think about your business, but I think the Midwest investors do want them more than the coastal investors. But I will tell you, every investor, when you get to a successful exit, is doing nothing but looking at, KPIs. You even, look, we can all go watch, the movie on Facebook, and at the beginning of it, that's all about KPIs. And, the guy who founded Napster's like, whoa, you're running at some big, fast numbers here. Dude, you're onto $1 billion idea. I don't see this that often. So don't ever think that KPIs and having that in your back pocket, front pocket, and center isn't critical.
I think that's also particularly true when things don't go as planned. Everyone loves a great success story, but I think what's just as important is how founding teams and executives are leading through times when things aren't going as planned. And if you're able to your point before around keeping investors updated and transparent, I think showing that you're able to navigate tough times through the metrics actually buys you a lot of credibility.
That's great. Yeah, I think trying to encourage people to really dial in on what the KPIs that matter are early and get disciplined about tracking it. And if they're not good, that's okay early on, but make that obvious to yourselves and sort of try and improve that over time versus sort of trying to cover it up and hoping no one finds out in diligence, because in the end you'll get found out. So.
And I think if you're doing your earlier fundraising, you just don't know where you're going to get traction. You're going to be talking to some people and it's way too early for them, but then put them on your list so they can track you and they can follow you and you can build a relationship with them. And once again, don't hesitate to ask them, hey, I get it, I'm not a good fit for you. Who would I be a good fit for? Who's out there that would be a really good fit for me? You've got to ask people constantly to help you out and give you feedback. And understand, investors for the most part are really smart. Listen to the questions they're asking you, learn from every single meeting, take notes the second you walk out of it of, maybe I didn't do so great answering that question. How can I do better on the next time? And they've got a point. Once in a while, I'm sure you'll run into an investor who's totally clueless, doesn't get what you're trying to do at all. And okay, but most of them are pretty smart and you look at it as free advice, even if they say no.
That's great. That's great. And I think early on, investors have a little bit of forgiveness on KPIs not being perfect, but I think just showing that you are really tracking it and have the discipline and sophistication to do that, that already sets you apart, right? You're already thinking about the right things and managing to the right things, and then that'll sort of play out over time. So Nicole, how did you get in touch with your first investors? That seems to be a sticking point in the Midwest as well.
Yeah, and to Michael's point, it's a relationship-driven business, which I think can work to people's benefit, but also can be very exclusionary for great ideas, which I think is something the industry really, really needs to work on. And I think probably many people are aware of that at this point. I was lucky enough to have worked in venture prior, so I did have a network. However, let's say that's not your situation. We did go through a technology incubator, which I think was very beneficial for us. We were actually in Philadelphia starting our business. One of the early founders of David's Bridal from the family was a mentor to us during our incubator. And so that's one of the reasons we chose to move to Philadelphia. And I think it gave us an opportunity to just be away from our friends and family, put our heads down and really launch the business. And it also built in a lot of discipline around everything we've talked about early on. But of course, that demo day did lead us to some very early and loyal investors. However, even if you don't go through an incubator, I think you can really start to plant seeds. And, you know, we were women founders, obviously, and back in the day, there was a lot of hype around that because there weren't that many of us, particularly that had raised meaningful levels of capital. So one network, for example, that we tapped into were some women's executive networks in Chicago. And it was sort of a breadcrumb situation from there. We were introduced to one woman who was part of a big women's executive network, and she brought in several angel investors along with her in those early stages. And that's really built on itself and has ultimately led us to introductions of bigger investors. We also really tapped into the Kellogg network. So for example, Jennifer Olson was an angel investor in Brideside. She was a Kellogg alum. She was the chief marketing officer of Crate & Barrel. I sent her a cold email when I was just running through the alumni list. She ended up responding right away. We got coffee with her. She invested. She introduced us to Rob Chesney, who is the COO of Trunk Club, who also became an investor. And so again, just sort of connecting those dots. But I wouldn't be afraid to tap into all of your alumni networks or professional networks early on and just build as big a lead list as possible.
And there's one question there about how do you build relationships in the COVID era. It's really a very tricky, I think it's a very tricky thing. I think that as much as I find Zoom exhausting, I actually think in an interesting way, Zoom has opened up the world, and I think Zoom has opened up a lot of access to relationships that otherwise might have been harder to get unless you were physically in front of somebody. So I think in a way, thinking bigger in today's world about making stepping stones of asking one person to introduce you to another. And I think part of that process is thinking about who do you know and you can introduce that person to. I think the more you give to people, the more you're going to get back. I find in my long time doing this, and one of the things that is my favorite part about doing this that I get to carry over from my investor days is helping people meet people to build relationships, build their businesses. And the more you help people, it may take, I mean, I literally just got a referral from somebody who I'd helped 20 years ago. You just don't know how things are going to play out in this world. And just, you got to be smart, and you've got to ask people to help you and help them back. And you can build relationships today, but it takes more effort, I think. But I think there's a much larger world of people willing to talk to you who would have been harder to get to 6 months ago.
I mean, I think it's always been a grind, and it's a grind now, right? But yeah, being smart about it. I always think fundraising is sales. So doing the upfront work to sort of make the story compelling, the pitch deck compelling, you know, finding those initial sort of soft sells of like people in your network that you can kind of sort of have a softer pitch and sort of get the feedback, and then, you know, see if they'll make introductions from there and be thoughtful about who you talk to when, and ultimately, you know, work the people through the process. That's going to be part of it as well. And I saw the question from Tim that you just answered, Michael. Yeah, the other part was just sort of the cold emails question. And investors get, you know, a bit of heat for relying on warm intros. And I've done it in the past myself. And really, the function of that is it's sort of a filter, in that, you know, there's so many startups out there, and people sort of trying to sort of filter down to just, okay, who's vouching for you in our network that can kind of get you in. Now, at the same time, that's also quite exclusionary. So, you know, people are starting to open up now. I think, you know, there's more and more sort of, you know, apply online. And if people, you know, don't get back to you on the contact us form, follow up. You know, there's just a lot of emails coming in these firms. Like generally the teams are quite small, so bandwidth is usually an issue. So don't be shy about following up. I'd say look out for sort of open office hours as well, other ways into people that, you know, even if you're not already in the network. I think it's good practice to try and get in someone's network. So, you know, if you're a fintech founder and I have a fintech portfolio company, you know, try and connect with someone at that company just for general, you know, networking purposes. And then, you know, if they like what you're doing, they'll make the intro. So it's just like that extra step of hustle to kind of sort of get into someone's network. It doesn't have to be that you know everyone. Just, you know, find some point of relevance and get in that way. And I think if you're going to do cold intros, cold emails, cold outreach, it can work, but I'd say make sure it's very custom. So don't send out a mail merge to 1,000 people, you know, dear first name, like that's not a good approach. But if you've clearly been on the website and seen that we've invested in a relevant portfolio company, and you can kind of show that you've done a little bit of homework on the fund you're reaching out to, they're more likely to then sort of read more closely what you've sent them. And again, don't be shy about following up. Yeah, everyone's inboxes are really busy.
And John, awesome. I mean, Jonathan, I do think that today with LinkedIn in particular, like I had somebody, somebody I just helped, they just got a new job in a great company. They saw on my LinkedIn, I was connected to some guy at Amazon, and they asked me to reach out to him, and I did it. And, you know, had they asked me, do I know somebody at Amazon? The truth is I probably would not have thought of him because I didn't realize he had actually moved, but they took the time to investigate and, you know, rummage through my LinkedIn account. And they're like, hey, do you know him? And, you know, hey, at the end of the day, it was good for me too, because I reconnected with him. And so it was a win-win. And there's one other thing that I'll never forget. And this goes back a long time, about 25 years. When I was first dating my wife, she had to go downtown to write the eulogy for the CEO of a large publicly traded company. And it was a Sunday morning, and she came back, and she had been down there with the CEO who had started in sales, and it was for R.R. Donnelley. And John Walter was the CEO, and he told her a story that I'll never forget and has been so important to me. And he said, you know, my mentor was a sales guy, and he told me for every 100 calls, you're going to get 3 or 4 sales, and that's it. But every call you make, you're that much closer to a sale. So just keep that in mind. Don't too many people take it as a rejection, not I'm that much closer to getting my goal accomplished.
That's great. Yeah, LinkedIn's a huge resource. You know, Crunchbase, you can find people on. PitchBook, if you're lucky enough to know someone that has access to that. AngelList, you know, there are databases out there where you can kind of sort of find who's out there, find your way into them through LinkedIn. And again, just work really hard. Awesome. Should we move on to structuring and deal terms?
Sure.
Yeah.
So, Michael, when should people be thinking about using sort of safes versus convertible notes versus preferred equity?
So the world today, I think, is very safe oriented. I tend to not want to use notes anymore. There's tax advantages to safes in places like Illinois. You can get angel tax credits if you use safes, which you can't get with notes. There are tacking advantages that some people take advantage of in terms of getting long-term capital gains. So I definitely think a safe is the way that we go. I think you need to be very careful with them. I don't think pulling one off of the internet is a wise idea. I've seen that cause more problems than I can shake a stick at. You've got to have a lawyer who knows what they're doing to customize it and understand how the instruments work and the tricks to them. But in terms of size, it's a really tricky question. I mean, I've been doing larger and larger safe deals as time has gone on, where people don't want to spend the time, money, effort, and friction on doing a full set of, you know, National Venture Capital Association style documents. I certainly think if you're raising money, doing a deal for much less than $1 million. You should always have your goal, in my opinion, being at least $1 million, because anything less, the friction is just too great. And at the end of the day, my personal belief and experience in the earlier rounds, and Nicole, you can comment on this, I always say capital is free, and people say, well, what are you talking about? Well, no matter the size of your round, if it's $1 million, $3 million, $8 million, $12 million, you get into some larger deals, whatever, 25, 50 million, and this starts to deviate. But you're almost always going to be giving up somewhere between 20 and 30% of your equity. So if you can raise $3 million instead of $1 million and sell 20% of your equity, well, look, you just made $2 million for no dilution. So you've got to figure out the best way to justify the largest amount of capital, because the transaction cost is very similar. I mean, Nicole, was that your experience?
Yeah, and I just saw someone ask a question. So a $500,000 seed round, is that a waste of time? No, I think you should raise whatever money you can. Not necessarily a waste of time, but to Michael's point, yeah, no, I totally agree with you. So we've done all structures. And I will say, I guess, a few things. One, when we were first fundraising, convertible note was sort of the way to go. Safes didn't really even exist. And I, that accumulated interest that ultimately then converts into equity, that can really catch up with you. So you sort of ignore it at the time. You're not really thinking about interest that you're not paying in cash. It doesn't feel like it's going to have that big an impact, but you don't know when you're going to ultimately raise that round that converts all the equity. And once that all converts, it really can catch up with you. So if investors are open to a safe format, I think that does tend to be very beneficial, and it's very company friendly. I've actually found that some investors, and maybe this has changed over the past year or so, are a little wary of safes. We got a lot of pushback when we tried to do it. Maybe people just weren't as familiar with it, and it sounds like times have really changed, but I would, definitely lead with that.
Can you explain what a safe is for people who are not familiar, and how it differs from a convertible note?
I mean, Michael, do you want to take the?
Yeah, I can.
I know it from my perspective, but you probably have the more technical.
Yeah, I mean, fundamentally, the big picture issues are the same. You're generally putting whatever, $1 million in. Generally, there's a cap at which the equity will be converted at, call it $10 million. So that if you put $1 million in and the company has a runaway success and does a round of financing at a 20 pre, your safe and or note will convert in at $10 million cap. So you don't just get totally no advantage to having been early money. The big differences is generally a safe does not have a maturity date, so it can hang out there in perpetuity, and a note will have a 1 to 2 year maturity date. A safe generally does not have any sort of interest component on it, whereas, as Nicole just said, a note will have an interest component on it. There's a lot of subtleties that can exist between the two, but those are the biggest differences. Most of them convert at a 20% discount, whether it's a safe or a note to the next round of financing, or they get the advantage of the cap, whichever is better. But there is a lot of subtlety as to what happens with pre-money option pools and post-money option pools, and different price, people end up with different caps as they go along that they negotiate. And then you need somebody who's really good at doing iterative functions on Excel, because everything dilutes everything. Jonathan's smiling. He knows.
I actually think, to that point, the benefit of a safe, I mean, there's been times when we had to raise a note on a note on a note because, like I said, our fundraising was never a straight line, and you don't really know how much capital you're going to need, or maybe you're fundraising for longer than you think. And when you raise that first dollar versus the last dollar, the company situation has changed, maybe even for the better, but it can get really messy. Whereas I think a safe tends to just be a little bit cleaner, and something that can hang out, as you mentioned, Michael, for a while, and you don't have to worry about having to be aware of when the maturity dates are coming up, or in the back of your mind knowing that, you know, monthly you're essentially accumulating this like supposed interest that then is going to waterfall down into equity when you convert everything.
So seeing a couple of questions come in, I think Michael's advice saying never raise anything below the million. I think, you know, there are plenty of examples of friends and family rounds or sort of pre-seed angel rounds that are less than that. I think his point was really just the cost of doing the transaction, you know, obviously is relatively fixed. And so for the smaller rounds, I think, you know, go with a SAFE or convertible note, those sort of simpler instruments. And I think, you know, the preference here seems to be SAFE if you can do it. And then, you know, really $1 million plus for a priced round. So if you're selling preferred equity, the documentation is a little bit more complex. So yeah, don't, you know, plan your fundraising based on the legal docs, but obviously just take into account there's a cost of doing this.
But I also want to be clear in that I'm not just talking about the legal transaction costs. I'm talking about the cost on your time.
Mm-hmm.
Your time to raise $500,000 is brutal, and your distraction from the business. And the second you raise it, you're not focusing on the business, you're focusing on fundraising. The second you raise it, you turn around, and most businesses who need this type of venture money are going to run through that fairly quickly, and you're going to turn around and have to raise more money anyway. So I more worry about the friction from a business perspective than I do the legal or other transactions. It's the transaction cost on your time and the company. The process is really very friction forward.
Friction forward. Yeah, I guess that's a good segue too into really thinking about how, let's say you are raising a priced round, and in those early days, you know, you don't, as you mentioned, Michael, founders can think, oh, well, I don't want to give up a lot of the company. And I guess, you know, one of my looking back on everything, I think valuations are completely meaningless and should probably be relatively meaningless to founders in the early days. I think it's really important that, like you said, Michael, you're able to focus on operating the business, and therefore you're really just, if you are fundraising and that is where your time is focused, make it a really structured process. And I wish I had been more disciplined about this in the early days. Have a start and an end date. Tell investors very clearly what that process is, because folks that want to wait and see or be the last capital in, just consider that a no. If they come in later, great, but that's not going to help your situation now. It's not going to help you gain momentum. And I think being really, really structured about that and setting a clear timeline, and then really being smart about how you're thinking about the round, and for me, the terms around participation and preference in the price round, or the type of board control that if someone's taking a board seat, the type of controls that a new investor have are far more important than the valuation.
I agree. If you tend to run out to a successful exit for a company, if you've got a $7 million or a $7.5 or an $8 million pre and around, it doesn't have as much impact as, you know, who your relationship is, how supportive are they going to be, and some of the control rights that could come back to get you. I was recently involved in a very large transaction where somebody had a lot of control, and the founders had to take money out of their pockets to pay the people who had control in order to get a transaction done, because people wanted to get returns. So you can find yourself with these control rights, which most of the times don't matter, but sometimes when they do matter, the consequences can be quite drastic.
And I very much believe at the end of the day, if let's say you think that you took a 50% hit to your expected valuation, something extreme, if you are outperforming and you're proving that you are priced too low, your board and investors want to see management motivated, particularly if you're a good operator. So in our experience, for example, we did, I forget exactly the circumstance of what happened, but we were taking dilutive capital, or maybe I think it was in our Series A, we took a slightly lower valuation than we wanted, but we negotiated in a huge options grant. And I think the founders, you know, your core team and your core operators, you're gonna do well if you're running the company well. They're going to keep motivating you, and you're gonna have a lot more negotiating power once you prove those results than when you're negotiating around the term sheet for your first capital in.
That's great. I just want to add a caveat to one thing you were saying, Nicole. I think in terms of like setting the time frame to raise is important, and I do believe it's a process, and you need to be driving people towards a date and trying to get critical mass of interest to sort of, have the round committed by a point. At the same time, I get people reaching out all the time saying, hey, we're fundraising, we're closing our round at the end of the month. And the answer, you're probably not. If like this is the first time I'm hearing about it, not saying that you've perhaps been at fundraising elsewhere, but if you don't have critical mass yet, sort of creating a fake deadline, sort of.
Yeah, I totally agree with that. And I think the round process, for me, you need to give yourself at least 6 months. So it can't be this like emergency thing where you're trying to cram it down people's throat. And I think you need to have a big enough lead list where everyone's been made aware. Maybe it takes you a month to give everyone a 6-month timeline or 3-month timeline. And it is this balance of creating urgency, but being reasonable. I think for me, part of something that's been very important, the learning experience, has been how to get the quick no's, actually. Like, I think that is where you can really like waste your time trying to do like betting on this one person to come in that continues to ask follow-up questions, that continues to do diligence. And I found 99% of the time they end up being a no if it's taking that long. So I think creating that, and I think great funds are good at this too. There's like a mutual respect there that you don't want founders to waste their time either way. But I agree with you that it needs to be thoughtful, and you can't create those fake deadlines. I think that comes across probably the very wrong way if you're on the other end of it.
That's right. Awesome. I had a quick question here from Riza Michael. Can you explain more about the difference between pre and post money? Getting a little bit more technical.
Yeah, so just a very simple example. Let's say that you are going to raise $3 million and you've got a pre-money of $7 million. 7 million plus 3 million gets you to 10 million. 10 million would be your post money. And then the investors, if the pre-money is 7 and the post money is 10, the investors would own 30% after you close the round. There's a lot of details in between that and what goes into the pre-money and what doesn't. And there's a lot of different ways to do these analysis, but fundamentally the pre-money is the price before you put the money in, and the post is generally that price plus the capital that went in.
Yeah. Without going too deep into sort of corporate finance 101, if you put $3 million of cash into a business, then you've increased the value of that business by 3 million, because that's an asset on the balance sheet, and in theory that's going into building additional value. So that's sort of how the math works there. Awesome. I guess I open this one to either of you. Is it better to sort of identify a lead investor early on, or go the other way and sort of try and get everyone interested first, then a lead investor emerges? Like, I'm not sure, Nicole, how you approach that.
Yeah. Having the lead anchor is really, really important to move things along. I think you'd probably spend like 90% of your time getting the lead and 10% getting in everyone else. So yeah, I do think it's important to find that person, but for me, it's just not been a straight line. It can go a lot of different ways, or I've sometimes had people, in the earlier rounds when we didn't have a large institutional fund, you have multiple sort of angel or seed parties that are coming in for equal amounts. So maybe, in my opinion, there's been a little too much emphasis on finding that anchor person as the answer to all your problems fundraising. I think maybe you can get creative in how you think about it, but yeah, I think finding 1 or 2 big checks early just really, really helps show that someone has put their neck out and believes in you, and it becomes much easier after that.
I agree. I think the earlier you can get a lead, the better off you are. If it's a good lead, then people will follow. There's a lot of times I see people who've got a bunch of smaller amounts of capital, and they'll all close if there's a lead, and that process can go on a lot longer than, Tim's comment, isn't it a 12 to 16 week process? I think Nicole is accurate of 6 months, which is why I said raise $1 million, because the transaction cost on your time in the business is brutal.
And then I would segment your investor list. Like if you have people who don't want to be first money in, but have said they might have some interest in closing out, maybe put those in a different bucket and just don't, maybe don't engage with diligence with them yet. Like spend your time focused on the lead and on the big checks first, and really get that secured before you go down the path of securing all of the smaller pile-on checks.
And one thing that just came to my mind, Nicole, based upon what you just said, is that to the extent any of you know portfolio companies of any fund that you think would be a great target, man, call the CEO or the COO or the CFO up at those companies and say, hey, what's this investor like? Are they a good partner or are they a nightmare? And by the way, can you introduce me to them if you don't know them? I think there's no better way to get to an investor than a portfolio company if there's a good relationship.
Yeah, that's a great point. And I saw someone just ask the question, which I actually think was a really great one, on finishing the round off. So if you don't have a lead, but you have raised 80% of what you need, my piece of advice is get the people who are already in to write a bigger check. I would just say, I mean, this happens to us all the time. I would just say, look, if you're willing to bet on me, and be very clear about the capital that you need. And if they're already committed, just say, hey, I can either spend another 3 more months focus on finding another 200,000, or if each of you put in 25,000 more, I'm done. If I'm an investor, I think it's actually a lot better to just double down if you're already believing in the company.
Great. Do you, should founders ever set their own terms instead of getting a lead investor?
We set our own terms all the time, but on early notes.
I think it's tough to do that, except if you're like going to friends and family. If you're going to friends and family, that's what you need to do. You also need to, I think, be careful not to outstretch yourself in terms of being too aggressive on evaluation or something, because that can come back to bite you, and I've seen it hurt people a lot. I can give an example of a well, I'm not going to go into the example.
Well, Michael, I mean, we've done, I think there's a few ways to think about setting your own terms. If you're doing it on a note or a safe, sometimes just having some early documentation that, like you said, has been sort of worked out with a lawyer, but maybe doesn't have, that you've come up with yourself, but is very market, incredibly reasonable, relatively vanilla, to just give something people to react to or get some early capital in. You may end up needing to change it later if you get a larger investor that wants to dictate the terms, which is fine. But I think sometimes just having something in place can help move things along to show that you're really serious and you have people committed to terms. But I totally agree with you, Michael. Really important to not be overly aggressive on valuation or terms. If you do that, you have to do something that seems almost like a no-brainer and very reasonable.
Right. It's like I was recently involved in a deal, and it's a teeny deal, and they wanted to have, like founder voting rights of 10 times anybody else, and it was kind of like, this isn't Mark Zuckerberg's company, it's just, don't do this. Like, don't have me do it. If it comes around and you're going to raise 20 million bucks in 3 years, and like, this really is amazing, and you've got a term sheet from Andreessen Horowitz and one from Bessemer and another one from, whatever, great. Then see if you can pull it off, but don't plan for things that aren't going to happen. Be practical, be commercial, and just get stuff done. That's
great. What are some other things that come up that are sort of, might seem like a good idea at the time, but end up being a bad idea later? Common, perhaps, landmines in term sheets or in sort of, founders markups to that.
I mean, I think some of the biggest mistakes I see made are around not carefully documenting intellectual property as you've built a company. A lot of the deals that we work with out of the business schools have a lot of issues on intellectual property, as a lot of people have touched it and people haven't cleaned it up, or people haven't clearly put their IP in, or you've got a relationship with third parties who are helping build IP. I think there's a lot of issues around founders' equity if it's not vested. amongst the founders, and one of the founders leaves, and you've got, you know, that what we refer to in the business is debt equity, meaning that you've got somebody who owns 25% of the company and left to go work at, you know, whatever, Apple, and now they own this huge chunk of the company, and you've got no way to reallocate it. I spend so much time and unfortunately so much money on fixing bad option grants that people have screwed up. It's a total mess. The rules are incredibly complicated. I do this every single day, and I still, at the end of the day, will not give a final piece of advice without talking to my partner who does nothing but options. And I know the rules pretty well, but there's always some subtlety that I'm like, are you serious? Like, that is ridiculous. But those rules were made for public companies, and it's not the smartest thing in the world that they apply to a private company, but they do. I think there's a lot of issues that people mess up on data privacy and cyber protections. I recently went to do an acquisition of a company, and the reality was the way they had set up their data privacy policy, they didn't have they had the rights to use all of the data they got from all of their, and this is just like what you put in your standard terms of service. So, you know, you just go put something generic in there. This is how it can come back to be a problem. They had no ability to transfer any of the email addresses. So there was no point in doing this acquisition, and the risk was just too great. And, you know, there's people who do texting marketing, and that comes into really costing a lot of money. You know, so there's certain things that I think are very easy to focus on and fix, and it tends to not be that high legal cost. And then there's other things, you know, and Nicole, you can comment on this, but, you know, generally things like a commercial contract between you and a client, although it's important, I tend to see those costing money to the company a lot less often than I do, you know, these other things that I just mentioned, which are kind of the high problematic things that man, it just kills me when I see these things come up. And forming a company outside of Delaware, if you want to raise any money, just don't even do it anywhere but Delaware.
Got it. That's great.
Yeah, I mean, I could definitely do a whole webinar on this topic. So maybe that's a follow-up. I know we have a lot of questions, but 100% agree and have a lot of stories there as well.
Yeah, this is great. We have a ton of questions and 8 minutes remaining. So what we'll probably try and do is capture some of these and see if we can sort of answer them in another form. So sorry.
Jonathan, do you want to go over a little bit if people want to hang on, or no?
I'm happy to do that.
I'm more than happy to spend. If we have a lot of people on the line, and if we can answer questions and be of value, I'm game.
Right. Nicole, would that work for you as well?
Let me quickly reschedule my next call.
No.
We can say it's fine. It's fine. Yeah, I can stay a little long. I just need to send a quick text message. But go for it.
That's huge. That's huge. Like your founder perspective, certainly appreciated there. Okay. Well then, yeah. Shall we run through some of these questions and then? Yeah. Okay. So one question. Yeah, we'll definitely be sending out Michael's collateral information after this. To everyone that signed up for this event. Examples of making a good pitch deck pre-revenue. That's sort of a whole topic in and of itself. So we will put something out on there on sort of what makes you a good pitch deck. I think we're going a long enough time to get into that. How does a VC define a co-founder? Michael, have you seen any sort of consensus around this? I certainly have a sense of, or Nicole, what would you consider a co-founder? Is it based on how much ownership they have, how much time they've been with the startup when they joined?
Yeah, I mean, I think going back to the point before, I think it's really important before you split equity in the company. I get this question all the time coming out of business school. You know, you're working on something together, you want to see how much traction you can get. And so you're talking about an operating agreement and starting to talk about how to split equity, or this person doesn't know she's going to be full-time, but another one knows she's going to be full-time. So we were in this situation. The original founding team was me, my co-founder, and another woman who we went to school with. She ended up leaving and taking a full-time job. We ultimately, thankfully, we bought her out relatively early, but like Michael mentioned, that can get really sticky. And in retrospect, I mean, you know, she was there for a class project essentially, and it was completely amicable, but in retrospect, I really wouldn't have even thought about equity until really we were up and running and we were maybe raising a round or something like that, or had some sales. And then, you know, later on, we brought a tech co-founder in for 10% of the company and considered him a co-founder. So I really think it depends on from like how you define it, just really what the relationship is and when that person comes on. And I think someone who owns 10% could, you know, likely still be a co-founder, even if you didn't split 50-50. So I do think that being thoughtful about that and having enough like traction under you to actually make smart decisions is really important.
You know, there was one other huge issue that I didn't mention that I do want to mention, and that is 1202 stock, QSBS stock. This is the greatest giveaway ever by the government. Basically, as a founder or an investor, if you get money, and there's a lot of complication and a lot of rules around this, so you got to talk to somebody who knows what they're doing with this. But if you get stock directly from a C Corp, and you hold it for 5 years and the C Corp meets the requirements, you get the greater of $10 million or 10 times the amount you invested in that company tax-free at the federal level. There is no better tax deal out there. There's really cool estate planning stuff that we do with this with families. And it is tragic how many times I've seen people just inadvertently blow this by doing just redemptions or other little things that you think, no big deal, I got to clean this up, and then boom, you've smoked yourself. So do not overlook that, because you don't want to look back after you've done all this work and then you could have saved yourself in today's world what will be a higher tax rate, I assure you, when you sell your company 5 years from now.
That's great advice. Awesome. Let's, if we're going to go 15 minutes over, perhaps let's just cover a few other things we wanted to cover, and then we'll try and get through some more of these questions. We actually had a few questions on due diligence and sort of what people would expect to see there. So just from a general sort of corporate housekeeping standpoint, what are the things which people, want to see during the diligence process? What should be in the data room?
Yeah, I mean, at the end of the day, every document that you've ever done, whether it's a tiny NDA or your offering documents of originally setting up the company, I can't tell you how many companies, and I'm sure if we had a voting functionality on here and asked how many people do board minutes and actually write them down and don't, it would be a very high percentage who don't keep good corporate governance. You really want to keep a very good data room, and something we prefer Box. Dropbox doesn't have the security of Box, but you really want to keep a very good data room in a pretty, in a relatively simple but organized manner. And just every time you do something, have the discipline to put it there, because when you go to do a deal and you're not deal ready and you're running around trying to look at your old emails, and if you're in Gmail, I can't find anything in my Gmail account half of the time, you're going to miss something, and then you might not be telling the investor something because you generally have to disclose it. But it's everything from your formation documents, the IP issue, showing how the IP got into the company, every person you've contracted with or employed, you're going to want to show you owned, their IP, how you did the option grants, the approvals for option grants, huge issue. People just give options out and they don't properly do a written documentation of them, constantly a problem. So you just, it really, everything needs to go in there, including your financials and how you've kept, your economics together, your books and records. They're going to want to see, income statements and balance sheets and all that stuff.
Yeah, I really couldn't agree more. I think when you are really like getting going with the company or raising your first round of capital, I would really go to a firm that really knows how to do startup governance that isn't going to overburden you with things that aren't necessary, but are going to help you understand what good corporate governance or housekeeping looks like, and actually walk through the process for all of the things Michael just mentioned. Have it written down. What is our process when an employee's hired and terminated or leaves? Let's go over exactly, let's make sure we all are using the same offer letters, for example, or an employment contract, that we have a file structure that is very consistent. Totally agree with you on the options and everything else you said. We definitely, some of the things that were headaches for us when we raised our A were definitely, we had done options approvals, but they weren't, like, we had issued them and the dates and the approvals were not consistent. So we had to go back and do a lot of rewriting. We had we had offer letters and NDAs or employment contracts that were like never scanned in, sitting on someone's desk. So for sure, I think just having a process up front that everyone understands, particularly as you scale and you bring in an HR department, just making that we've had time for people who are using like different NDAs and we considered ourselves very organized. And I would say, like, I was actually surprised how, we could have been even more organized.
And I kind of quasi joke, but it's not really a joke. If you use somebody, like us who does this every day and can get you to the right place pretty quickly, I analogize it, to brushing your teeth. You can either choose to brush your teeth every day and you got to buy toothpaste and toothbrushes and it costs a little bit of money, or you can choose to get an implant when the time comes and you need to clean all of this up and it costs a ton more to clean it up just from a legal perspective. And then frankly, there's all the economic pain that comes when you have to, I can't tell you how many deals I've done where we've had to cancel every single option and reissue them at a higher strike price. And then you as a founder are going to have to go to these people and say, yeah, gee, I screwed this up. If I don't fix this and reissue it, I'm really sorry, but you're going to have a 20% excise tax on top of this, likely being ordinary income. So even if we're successful, you've kind of not going to get much money out of this. It's just, it's heartbreaking, it's painful, and I can't even tell you how many times I've had to do it.
I would say there's two other situations like this that, one, as you mentioned, I think sort of before, there's really like no such thing as sweat equity. That is actually an incredibly complicated concept that I would very much discourage early on, and I would really discourage you from trying to just like put in place some sort of like ad hoc equity agreement for someone that's working for you for free. And also advisors too, like advisory equity can be incredibly complicated. And I think if you do issue these things as non-qualified options, or if you do have incentive stock options, particularly when someone leaves, really being disciplined about their timeline to exercise and being maniacal about tracking all of that. We had to go back with an advisor and completely rework everything because he like didn't exercise his advisor options on time, and it became so much more complicated than it would have been had we just like had a process at the beginning.
Seen it again and again, the shortcuts.
Right. It's never worth it.
Always come back to bite you. Yeah.
Right.
So I'm just going to be jumping around now, trying to cover.
Okay,
We have everyone on the line. We have sort of 50 questions, so we'll do our best here, but it's going to be tricky. Thank you for the interest. I guess, Michael, a few people, I guess, tuned in at the end of what you were saying on the 1202 stock. So would you mind just sort of repeating that quickly?
Yeah, so basically, there's like, we have 10,000 articles. You can go to Neal Gerber's website and find articles on it, or if anybody wants like a more serious article on it, you can feel free to reach out to me and we'll send you what we've done on it. But fundamentally, you've got to be a C Corp. The value of the company needs to be under 50 million. The stock that is eligible must be retained from the corporation. So if I own stock and I sell it to Jonathan or I sell it to Nicole, that cleans it of being 1202 stock. So let's say let's say Nicole, Jonathan, and I are founders and we own the company a third, and we realize, you know, I'm not pulling my weight. So I say to Jonathan and Nicole, look, I'll sell you half of my stock. I see this all the time, so that we get a better, you know, equitable situation in the company. We're all like, yeah, that's fair. None of us have an issue with it. Well, now all of a sudden, the two of them are owning a big chunk of their stock that's not 1202 eligible. But the benefit is that even if you've paid nothing for this stock or you've put $1,000 in as a founder, you get, if you hold it for 5 years and you're the right type of company, you can't be a restaurant or a hotel. But if you meet the requirements and you don't blow them, like by buying stock secondarily, you get $10 million tax-free at the federal level. Like to spend a little money with somebody who knows what they're doing on that is the best option value you can buy for yourself if you think you're going to be successful.
Great. And just on the corporate entity types, I have a question here on B Corps. I guess, can you just touch on what they are super quickly? And then is being a B Corp a deterrent for VC funds?
I don't necessarily think it's a deterrent. I haven't seen a ton of B Corps getting VC funded. We've definitely dealt with B Corps. Most of the B Corps we've dealt with are consumer-oriented companies, largely more often than not in the food space. I think they have a lot of merit to them, but it hasn't really come up as an issue in the venture space, at least for me till now, you know, now. But they're a great vehicle, and you know, there's nothing wrong with them.
Yeah. My sense is most VCs just consider it a C Corp, that the ones that are not impact minded. And then a question here, I guess, you know, some people form an LLC earlier, not a C Corp. Any thoughts on the right time to do one versus the other? Looks like someone may have either already or was thinking about incorporating in Nevada instead of Delaware. Can you just touch on that?
Yeah. Another one of my favorite things. The great things about LLCs is you can pretty much do whatever you want to do with them. They've got about as much flexibility as anything out there. The bad thing about LLCs is they've got about as much flexibility out there, and you can do anything, and you can end up racking up huge legal bills trying to figure things out. At the end of the day, and there's a really cute 1202 trick that you can play if you start with an LLC and convert to a C Corp. Do not ever start with an S Corp, because that can never get 1202 stock unless you do a very complicated restructuring. But in general, if you know you're going to get VC money, there's very few circumstances where the friction and cost of starting out with an LLC is going to pay off. It may be that your earlier investors want to get flow through losses and then do a conversion later. But these conversions are, I've done 8 or 10 of them in the last 6 months. They're very complicated. They're very expensive. It's very complicated to convert the profits, interests, or the equity grants that employees have gotten in the LLCs into just a normal option plan. If you don't think you're going to raise venture money and you can raise this with friends and family and you're going to be pretty capital efficient, there's a lot of interesting things on the LLC front. There are tax differences between the two. You don't get the 1202 stock advantage with an LLC that you get with a C Corp, but it's a complicated analysis that outside of just pure, I got to do VC, there's no other route. And frankly, I think a lot of the VCs should be thinking about LLCs in circumstances, but they just won't. You know, if you look at the private equity world, the vast majority of them are done through LLCs, but old habits die hard in the venture world. If you're going for venture money, generally just start with a C Corp and call it a day. So it's a lot harder to go from a C Corp to an LLC. It's much easier to go the other way.
That's great. Nicole, I had a question here from someone wondering sort of how to think about founders' salaries sort of pre and post raising. Obviously, you don't have to disclose.
Yeah.
Your
Actually, I answered it. I typed an answer there and I did disclose, because I think this is a good question that people, that tends to be like taboo and no one talks about, but we tend to be very open about it. And everyone has a different situation. And I think we always, you know, we felt that we tried to keep our costs really, really low for as long as possible. And that, that bought us, you know, a lot of time and a lot of runway, and that included our salaries. So when we graduated from business school, we weren't paying ourselves really anything. We went through an incubator. We were then probably at like 36,000 a year. It wasn't really until we raised meaningful capital, several million, that we even went to any sort of like real salary, but was still very discounted. And it wasn't until our A that we went over six figures.
That's great. Excellent. Got a few other questions here. Have either of you sort of looked at Mike Moyer's slicing pie methodology in terms of divvying up equity early on in terms of compensation? Are you familiar with that?
I'm not familiar with it.
What's the question?
Any opinions on Mike Moyer's slicing pie methodology? It's a way of sort of divvying up equity based on, you know. No.
I don't know. No, I'm not familiar actually.
Sorry, Delvin.
Sorry about that. I'm interested though.
Yeah. It's a book. I've not read it, but
yeah,
some way of sort of how, you know, being fair for
right.
people who are sort of working just for equity on the sweat equity point, I think.
Right.
Okay, 5 more minutes to go, and then we will end this. But thank you so much for everyone for sticking around. I guess, could you give a sense of sort of what kind of traction you had at each stage, Nicole, and just sort of you know, what you think general rules would be, you know, for other people out there?
Yeah, and again, we were a B2C business, so I know for software businesses this could be very, very different. But yeah, I think when we were like really early revenue, sort of pre-revenue, a lot of it had to do with how like the progress we were making on the top of the funnel metrics. So whether it was like site traffic or email addresses, signups we were getting, or for us, because we were a retailer, the amount of designers that we were closing to get product on the site, things like that. As we moved, and that was probably year 1, year 2, 3, and 4 were really around that ramp up. So I remember like looking back, it was like, when did we hit 10,000 a month? And when did we hit 100,000 a month? And we were always studying, we were like, okay, we think we can raise more capital when we hit 100,000 a month. And I think like from there, it was really looking at, honestly, just making sure that we were at least doubling or tripling every year, whatever like our top line metrics were. I think at a minimum to raise capital, I mean, I don't know in COVID, but my opinion is you probably need to be at least doubling your top line to be seen as that sort of like high growth, and maybe for many companies even more, depending on what industry you're in.
That's great. Any cautionary advice around raising money from friends and family? It sounds like you might have gone that far earlier.
Yeah, I mean, I never wanted to do that personally. And if I did, you know, we've had some like business school friends that have invested, and I just tell them, yeah, pretend this is like your drinking money. You're flushing it down the toilet. Do you still want to invest? I just can't stomach the idea that someone is going to invest an amount of money in my personal network that is like needed, or that they're relying on for a real return. I just can't personally take on that. You know, I feel much more comfortable. No, I don't feel comfortable losing anyone's money, but I can at least stomach an institutional investor, you know, more traditional, that really understands a full risk profile and has a big enough portfolio to mitigate risk in any one deal. But with friends and family, I think if you're going to do it, which, you know, maybe what needs to happen, that you just let them know, like pretend that you're just like throwing this money away, and then anything from there is upside. That's just my personal opinion. Others might have different opinions. But
My opinion is your smallest investor will be your most difficult investor.
that's also true. Great.
Yeah. And then last one for you, Michael, and then I think we'll have to wrap this up. Is it difficult to transition from an LLC to a C Corp? Or if you're an Illinois C Corp and need to move to a Delaware C Corp, you know, is it really painful, or is it pretty straightforward?
It's relatively straightforward to go. Well, it's not that straightforward to go from any LLC to any corp. That always requires a lot of thought and work. It's not that hard to generally move from one state to another, but it tends to be very expensive because all of the states want to earn filing fees for you leaving their state and joining their state. So you generally can't just like convert over by filling out. If you start in Delaware as an LLC, you can fill out one piece of paper and become a C Corp. But if you're in Illinois or like, for instance, Missouri, because I'm doing it right now there, you have to do it through a merger. And so you end up with a bunch of paperwork, and it costs thousands of dollars in filing fees and paperwork, when it just, if you start in Delaware, you might pay a little bit more. But the clarity of the law there is invaluable if you ever have any issue. And then if you want to convert, it's a lot easier.
That's great. Well, I think we'll have to end it there, but thank you to everyone. It looks like a lot of people stuck around for the extra.
Yeah, it's great.
Yep.
And appreciate Michael and Nicole sticking around as well. We will take the rest of the questions and try and pull out some themes and perhaps put out a blog post or something to address some of these. There's obviously a lot of things we could have covered, and 1 hour was perhaps ambitious, but glad we got through a lot of it. Look out for we've got 3 events next week, so please check your emails on that. In terms of reaching out to any of us, I'm a pretty open book, so you can connect with me on LinkedIn, follow us at midwest.tech on Twitter. You know, however you want to reach out. A lot of you have our contact info from signing up for the conference. Michael or Nicole, is there a way they could perhaps contact you if they have follow-up questions?
Email, phone, it's on our website, easy to find. You can ask Jonathan, he knows. Both Jonathan and Nicole know where to find me.
And I'm Nicole at brideside.com.
And I'm just mgray@nge.com.
Awesome. Okay, and so a couple of questions. Yes, we recorded this whole thing. We will make it available. Exactly where TBD, we'll probably put it on the website or at least send it out to registered attendees. But thanks everyone for joining us, and have a great weekend.
Have a
Thanks,
great
everyone.
weekend. Thanks.
Bye.
Bye.